Welcome to the deep dive. You've given us some really detailed sources this time outlining a major initiative, the plan to create a Confederal Investment and Development Bank for the Sahel. Quite something. So our mission today really is to cut through the noise. We want to give you the shortcut to understanding what's truly at stake here. We need to look past the big instruments and unpack the sheer scale of this proposed bank and, crucially, pinpoint the execution challenges it's facing, like right now, and figure out, okay, what are the specific, maybe technical conditions it needs to actually deliver tangible results for people in the region.
Absolutely. And it's launching into a context where, frankly, the stakes couldn't be higher. You've got three countries here with just immense development needs. But they're dealing with these twin constraints, right? Severely limited national budgets and, this is critical, a really high cost of capital if they want to borrow for big infrastructure projects. So the idea behind this Confederal Bank is, well, it's a strategic countermove. It's meant to be a vehicle to pool resources, structure financing differently, share some of that risk, and importantly, shift the decision-making power closer to the region's own priorities, make it more local.
That strategic thinking, it sounds powerful. And the sources, they list the core ambitions clearly. Roads, energy, water, agriculture, connectivity.
Yeah.
The big five. Targeting the fundamental pillars of economic growth, basically all at once. But is that realistic? For a completely new financial institution, doesn't starting so broad increase the risk it just gets spread too thin, maybe ineffective?
That's a very fair point. And the sources definitely acknowledge that danger, the risk of mission creep. While the long-term scope covers those five areas, you're right, the initial execution, that has to be laser-focused, extremely targeted. They simply can't fund everything right out of the gate. They absolutely must show success, real tangible success, in maybe two or three key areas very quickly, just to build that essential confidence, which means the blueprint itself, how the bank is actually set up operationally, that needs to be, well, impeccably solid from day one.
Okay, let's dig into that blueprint then. Because a development bank, it needs way more than just political will, right? It needs actual structure. The number one requirement listed in the sources is liberated capital. That's a strong phrase. What exactly do they mean by capital that's actually liberated, not just, promised?
That's the key difference. It's a difference between a political pledge on paper and, well, actual hard currency sitting in the bank's accounts, ready to go. Liberated capital means the member countries, the shareholders, have physically transferred the agreed funds. It's capital the bank can immediately use, either as equity to back its own lending or as collateral to borrow more money from others. If the capital is just pledged basically an IOU on a government spreadsheet, the bank can't really lend effectively. And maybe more importantly, external partners. They won't trust its long-term financial health. Honestly, this failure to actually liberate the capital, it's probably the single biggest reason new regional institutions like this sometimes stumble.
Right, which makes the governance structure absolutely critical then. So beyond the money, what are the other absolute must-haves before they can even think about making the first loan?
Okay, you need fully professional governance structures. That's non-negotiable. Clear risk and credit policies that are crucially depoliticized, not subject to sort of day-to-day political whims. You need an experienced independent management team, people who know development finance inside out, and of course, a modern, secure IT system for managing everything, especially disbursements. Without that basic infrastructure, the bank is just, well, it's just a name and a logo, a shell.
So we have the blueprint components, but the analysis you flagged points to three really decisive hurdles. Hurdles that determine if this bank actually moves from being an aspiration to, something real that executes projects. Let's tackle the first one. It seems like the hardest one to fake, credibility.
Yeah, credibility isn't something you're just given, especially not for a new institution like this. It has to be earned. And earned through operational proof, hard evidence. External partners think multilateral banks. Private investors, they'll only really engage, only put their own money or reputation on the line if they see solid evidence of internal rigor. So what does that mean practically? It means transparent statutes, publicly available, an independent risk committee whose decisions, maybe even summaries, are published, regular audits done to international standards, and increasingly important now, robust environmental and social policies, ESG. If a major development partner looks at the bank and sees, weak standards on environment or social impact, they stay away. And that cuts the bank off from the low-cost, long-term financing it absolutely needs to function.
Okay, credibility is hurdle one. The second challenge you highlighted is execution speed. We all know in the development world that gap between announcing a project and actually seeing money flow, seeing dirt move, it getting stretched into years sometimes. That kind of delay, it feels like it could kill political support and public belief almost instantly, couldn't it?
It absolutely could. It's what they call the demanding process chain. Think about it. If you go to a commercial bank for a business loan, you might get an answer in, what, 90 days? Maybe less. A development bank, though, it has to navigate this incredibly complex path. Feasibility studies, multiple layers of political approval, often competitive international tendering for contracts, then environmental impact assessments, detailed risk control checks. I mean, globally, that whole process often takes 18, maybe even 24 months, sometimes longer. So this new bank, it has to master that chain, but do it with both speed and integrity. That's the challenge. Because every single month of delay doesn't just add cost to the project itself. Crucially, it damages the perception that this institution actually works, that it can deliver. Getting that due diligence done quickly but properly is vital for confidence.
And the third big challenge, coordination. The Sahel region already has players on the field, right? Local public banks, commercial banks, various guarantee funds, not to mention the big international donors like the World Bank or AfDB. So what specific role, what unique niche does this new federal bank need to fill so it doesn't just end up duplicating what others are already doing or trying to do?
That is probably the core strategic question they need to answer. The bank's real value isn't created by trying to replace these existing institutions. Absolutely not. It's created by leveraging them, by working with them. It needs to use its capital strategically, perhaps, to de-risk certain projects, making them more attractive for, say, local commercial banks to co-finance. Its unique function should probably be providing that adaptive, maybe longer-term credit or tackling projects with a risk profile that existing regional players, maybe like the West African Development Bank, BOAD, or specialized guarantee funds, either can't or won't touch right now. If it just starts funding, I don't know, small SME loans that local banks could potentially handle, then yes, it risks just duplicating efforts and, frankly, diluting the overall financial firepower available in the region. It needs to add something new.
Okay, this is where I think we need to connect the dots. We've been talking about liberated capital, risk committees, co-financing, pretty technical stuff. Why should the average person, say in Niamey or Bamako or Ouagadougou, actually care about these, incredibly technical details of how this bank is governed? What's the real tangible link between, say, a good risk policy and their daily life?
Because ultimately, failure in governance isn't just an abstract problem, it's paid for by the citizen, directly or indirectly. When a development bank is poorly governed, when it's seen as risky or opaque, what happens? External lenders, the ones providing a lot of the actual cash, they view it as higher risk. And what do lenders do when they see higher risk? They charge a higher interest rate. They add a risk premium to the cost of the loan. And that higher cost, it gets passed down, right down to the individual projects.
Can you give us a concrete example? Like, how does that actually play out?
Sure. Let's think about a really critical project. Say, paving 100 kilometers of road connecting a farming region to a major market town, a vital economic link. Now, if this new Sahel bank is well-governed, perceived as stable and transparent, maybe it can borrow the money needed for that road relatively cheaply on international markets. Let's say the road costs, hypothetically, $50 million to build. But if the governance fails, if the bank is seen as politically unstable, if its decisions seem opaque, if audits aren't clean, suddenly its borrowing costs might jump, maybe by 2, even 3 percentage points. That's huge on large sums. So that same 100-kilometer road project, it might now cost $70 million. What does the citizen see? They don't read the risk committee minutes, right? They see maybe only 70 kilometers of road getting paved instead of 100. Or they see that vital project to electrify their local health post getting delayed, stalled for months because the funding is suddenly too expensive or too slow to arrive. That's the real-world impact. So a well-run bank, it acts as this essential mechanism. It attracts the cheaper concessional financing. It negotiates guarantees to lower risk further. It finds ways to share risk with private investors. And all of that works together to make that health post, that usable road, that reliable water pump affordable and deliverable. A dysfunctional bank, on the other hand, it just risks tying up valuable pledged resources, money promised, but not actually doing anything, immobilized.
Okay, that makes the stakes very clear. Now, the sources you shared, they lay out 3 quite distinct scenarios for how this could unfold over the next few years. It's like a spectrum, really, from a steady, maybe slow start, all the way to potential failure. Let's start with scenario 1, the central path, the one described as the most probable starting point. What does that look like?
Right. This is seen as the gradual, but probably realistic way things begin. The key feature here is that the capital is partially liberated, meaning the member states put in enough money to get started, to show commitment, but maybe not the full amount pledged initially. Enough to begin operations, but not enough for large-scale financial independence right away. In this scenario, the bank focuses heavily, initially, on just getting its house in order, publishing rigorous credit and risk policies, getting the internal processes right. And their initial project pipeline. It consists of just a few carefully selected flagship projects, things that are manageable in size, visible, and can show results relatively quickly. Think maybe small, decentralized solar energy grids for rural villages,
Yeah.
or targeted rehabilitation of a few really critical cross-border trade routes, or perhaps some rapid pilot irrigation programs in drought-prone areas. Small, focused wins.
And the crucial safety net in this scenario, reading between the lines, seems to be co-financing. Is that right?
Exactly. That's critical in this central scenario. Almost every single initial operation is co-financed with existing partners. Could be regional banks, could be multilateral institutions like the World Bank or AfDB. This does two things. First, it limits the new bank's own financial exposure right at the start when it's most vulnerable. Second, it acts as a kind of external validation, a de facto seal of approval. If established players are willing to co-invest, it builds confidence. So the goal here isn't, immediate region-wide transformation. It's about steadily, methodically building credibility over, say, the first 2 years. And success is measured by clear, verifiable indicators. How many megawatts of clean energy added, how many kilometers of key road rehabilitated, secure access to water for how many more people, and maybe most critically for internal credibility, what's the average processing time from project application to first disbursement? That needs to demonstrably decrease.
Okay, that's the steady path. Now let's look at scenario 2, the favorable path. This is where the institution really hits its stride, accelerates, and starts fulfilling that big potential we talked about.
Right, this is the aspirational goal. This happens if, and it's a big if, the governance and the execution in those first couple of years are so rigorous, so professional, that they achieve a major financial milestone. What kind of milestone? Maybe securing a strong independent credit rating from an international agency, or perhaps getting a significant guarantee enhancement from a major international body, like MIGA or similar. What that does, fundamentally, is it unlocks access to large amounts of relatively low-cost funding directly from global capital markets. They're no longer just relying on the initial shareholder funds or piecemeal co-financing. They can raise serious money efficiently. And with that financial firepower, they can broaden their scope, move beyond just basic infrastructure, maybe roll out specialized lending desks designed specifically for small and medium enterprises, the SMEs, or dedicated programs for boosting agriculture productivity, things that have huge development impact.
And what would be the visible signs of success? How would we know if they're actually on this favorable track?
You'd see the bank becoming a real hub, a central pivot for large-scale co-financing efforts across the region, attracting other investors. You might even start to see the overall cost of borrowing for major projects in the region begin to trend downwards because the bank is helping to mitigate risks. And then the concrete results become more widespread, more visible, things like genuinely fluid logistics corridors where trucks aren't stuck at borders for days, maybe local digital payment systems starting to actually work reliably for small businesses, sustainable, secure water access being rolled out across multiple pilot communes, not just one or two. Essentially, it moves from being this ambitious idea on paper to being a recognized, influential financial powerhouse driving tangible change.
Okay, that's the upside. But there's always the downside risk. Scenario 3, the unfavorable path, the failure mode. But reading the analysis, this seems to be defined less by external factors and more by internal paralysis.
That's exactly right. This scenario, the failure pathway, it often starts with that initial sin we discussed, a significant delay in the actual liberation of capital. If the money doesn't arrive, it undermines solvency and credibility right from the beginning. But what really cements the failure, according to the sources, is often political interference in the bank's operations. Appointments to the board, to senior management, they become divisive or opaque, based on political connections rather than genuine merit and expertise. And without that rigorous independent governance, the bank really struggles. It finds it hard to attract and retain the experienced, high-caliber international staff needed for complex development finance. Those people demand professional environments. So what happens? Announced deadlines are repeatedly missed, project pipelines remain empty, and those crucial external partners, seeing the lack of traction, the internal issues, they refuse to engage, they hold back their funding and expertise.
And the end result of that kind of internal failure?
Well, the bank essentially becomes unable to structure or fund any meaningful operations. It ends up being seen as just a costly duplication of existing structures, but without any real impact. And tragically, it quickly morphs from being the symbol of regional hope and self-determination into potentially a symbol of disappointment, a visible example of poor resource management. A white elephant. So if you zoom out and look at these three paths, the crucial difference between the successful scenarios, the central and favorable ones, and that unfavorable one, it isn't really about how difficult the region's challenges are. We know they're immense. The difference really boils down to pure disciplined execution. And that execution is driven primarily by two things: strong independent governance and a really smart focus strategy.
Okay, let's really focus on that playbook for success then, particularly around the strategy and managing the risks involved. You mentioned irreproachable governance. We need to be clear. What does that actually entail in practice? What are the non-negotiables?
Right. It means, first, having statutes, the bank's founding legal documents that explicitly establish a board of directors and key committees, like risk and audit, that are genuinely independent from the short-term political cycles of the shareholder governments. This usually requires clear published rules for how members are appointed, their required qualifications, and crucially, very rigorous published rules for managing conflicts of interest. How do you ensure decisions are made for the bank's long-term health, not for personal or political gain? And then there's the transparency aspect. Regular, mandatory publication of fully audited financial statements using international accounting standards. The board's primary duty has to be to the long-term solvency and mission of the bank itself, not necessarily the immediate political needs of any single capital city.
And strategically, you mentioned the bank has to share risk if it wants to really accelerate development, especially in a challenging environment. The sources brought up something called cascade co-financing as a key technique. That sounds like serious financial jargon. Can you break that down? What does cascade co-financing actually mean for the listener?
Yeah, it sounds technical, but the concept is fairly straightforward. It's basically a way to manage risk on large, complex, or inherently uncertain projects by funding them in defined stages or cascades. So instead of the bank giving a project partner, say, the full $10 million commitment upfront for a big multi-year infrastructure project, it might commit the $10 million on paper. But initially, it only disperses, say, the first $2 million tranche. The release of the next $3 million tranche is then made strictly conditional. Conditional on what? On the project verifiably hitting specific, agreed upon performance milestones from that first phase. Milestones could be anything: completing site preparation, finalizing procurement contracts, achieving a certain operational benchmark, whatever makes sense for that project. What this does is protect the bank's capital. If the project runs into unexpected problems early on, maybe political delays, maybe operational issues, the bank hasn't yet committed the bulk of the funds. It limits its exposure on that single project and keeps those undispersed resources available for other, potentially more viable projects. It effectively shares the risk across time and performance, rather than putting all the money out there at the very beginning.
That sounds absolutely essential for managing the kind of volatility and country risk you inevitably face in the Sahel region. What other tools or techniques do the sources say they need to use to manage those potential delays and risks?
Well, alongside that kind of conditional disbursement, another key technique is using performance-backed payments, especially for contractors. This means shifting payments so they're tied more closely to actual outputs delivered rather than just inputs used. For example, instead of paying a road construction company based purely on, say, how many cubic meters of dirt they moved or how many tons of asphalt they laid, which are inputs, you structure the payment so they're released when specific sections of the road are certified as fully complete and functional to a certain standard, which is an output. It incentivizes completion and quality. But underlying all these techniques is finding the right overall appetite for risk for the institution. This is a delicate balance. The bank must be brave enough, willing enough, to invest in projects and sectors where purely commercial banks won't go. That's its purpose, to push the boundaries. But at the same time, it has to be strategic and prudent enough not to compromise its own long-term financial viability by taking on reckless or unmanageable commitments. Finding that sweet spot is key.
And wrapping up this playbook for success, what about managing public expectations? If they can't realistically promise miracles, especially at the start, and need to move carefully, what should the communication strategy look like?
The sources strongly advise what they call frugal and factual communication, essentially. Make very few promises, but provide a lot of proof. Hard evidence of progress. Transparency becomes their single greatest communication tool here. This means doing things like setting up a public, easily accessible online dashboard, maybe right from day one, showing key impact figures for the projects they are funding, being upfront about average processing times, even if they're initially slow, detailing the cost, and, importantly, the co-financing partners for every single approved project. They need to be honest about the inherent complexities and potential delays, while consistently demonstrating that, yes, slowly but surely, the money is being put to work and is translating into tangible results on the ground. Manage expectations through radical transparency.
So let's bring it all together. What does this deep dive really tell us about this initiative?
The political will to create a confederal Sahel bank. It's clearly powerful symbolism. It represents this unified decision to invest based on local priorities, maybe reducing reliance on the sometimes shifting agendas of external donors. But the strong warning coming through from all the sources we looked at is that the symbol alone, it's entirely dependent on the substance. It's not enough by itself.
Absolutely. In the end, the success of this bank won't be measured by the size of the initial pledges announced at summits or the number of staff it hires. The only metric that truly matters, the one citizens will judge it by, is the tangible results. Finished projects, functioning services, logistics costs for businesses and farmers actually decreasing, verifiable improvements in the quality of life, credibility in this massive, ambitious venture. It won't be granted up front. It has to be built painstakingly, deliverable by deliverable, proof point by proof point. That pressure to get those early wins, those measurable successes, seems immense then. Which brings us to a final thought for you, the listener, to mull over. If this new bank had to choose just one sector to focus its initial efforts on, purely to build maximum momentum and credibility as quickly as possible, just one area to secure those quick, visible, measurable successes we talked about, which should it be? Should it be decentralized clean energy for villages? Or upgrading a single high-priority logistics route? Or perhaps rolling out intelligent water-saving irrigation in a key agricultural zone? Something for you to consider and perhaps explore further as this ambitious institution attempts to move from paper to reality. Thank you for taking this deep dive with us.